All right, folks, welcome back to the Property Couch podcast, and we've got an amazing show lined up for you today. But I've got a question for you. What does the big day out, drum kits, and tax have in common? Well, you'll have to stick around to find out. But what else do we cover today, Ben?
Yeah, Bryson, what's making property news? I feel a rant coming on, very frustrated with New South Wales decisions on rental reforms in that state. So I'm going to tee off a bit there, I think, as well.
Ben's going to tee off, folks. You've got to stick around for that. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, mate. How are you?
Mate, I'm well. The weather was being great recently, so I've been out and about with the kids, having a bit of fun and seeing a few different things. I saw Bernard Fanning and the guy from Something for Kate. What's his name? Paul Dempsey, I think that's his name.
Ooh.
That was great. I went to a couple of gigs and I saw Will Anderson and Adam Spencer do a little comedy routine off the back of their Triple J breakfast show from years ago. But I've been out and about. It's spring. You get time to go and enjoy yourself. So life's good.
Life's good, mate. So can you tell us, did you actually watch those two events through your eyes, or did you have your phone up recording it?
No, I'm one of these people who basically watches it through their eyes. I did do a 30-second snippet of Bernard Fanning doing a Powderfinger song, because that's the first time I've seen him actually do a Powderfinger song outside of obviously not being in Powderfinger itself. So I thought I'd capture that moment, because I've seen Bernard Fanning plenty of times, and as a solo artist, but I'd never heard him do a Powderfinger song.
I'd be proud of you, Ben. You got your phone out and you recorded something, mate.
Well, I needed to show Jane, because she obviously didn't come along.
Who would have thought?
It was a date night with a mate, other than my beautiful bride.
How exciting. Hey, we've also got some exciting news regarding Money Smarts coming up, Ben.
Yes, we do, Bryce. We've been working diligently for a long time. Now, remember, the origins of Money Smarts was basically a rules-based money management system, an incredible, easy-to-use money management system that took less than 10 minutes a month for you to manage your money, organize it really simply into regular and irregular, so you can account for that. It sort of threw away the old budgeting systems that don't work. And then it migrated onto what we used to call the My Wealth portal, which has now evolved into the Moorr platform. And so we've now done a significant upgrade. I'm talking from the whole ground up. We've redesigned it, and it's now going to form part of a very sophisticated money management solution that we're building into Moorr. So it's taken months and months of rework. And there's, Bryce, there's over 11 million data points that we've had to adjust and cleanse as part of all of the records of all of our tens of thousands of registered users on the platform. So we've been doing all of that back-end work and tidying all that to just bring it into the next generation. So it's Money Smarts 2.0, and it's coming in a matter of days, not weeks anymore, Bryce, but a matter of days.
So do we pin you for a date, Ben, or do we just say, coming early November?
I can just say, let's go early November. We've got a working date, which is I'm not going to disclose. Originally, that working date, look, let's be honest, that was the end of October. So that date's just pushed out a little bit as we're doing all of this sort of cleaning up of the data, but it now fully integrates with the whole Moorr platform. So not only can you obviously run Money Smarts as a standalone sort of tool inside the platform, but all of that rich intelligence and data and insight is now going to be in our card system. We're building a transaction layer. We're doing all of these exciting things. It's just going to make effectively Money Smarts and the Moorr platform just that one step above. Remembering now, Bryce, that Money Smarts and the overall Moorr platform has more features and tools than any other personal money management platform on the market. And it's still free, Bryce. It's still free.
If anyone doesn't use it, Ben, they'd be mad. moorr.com.au. They should go and check it out. But we've also been cooking up, you, me, and Stiggy. We've been in the kitchen, Ben. And
yes.
Because what happens is people come to our podcast now, like we've had some people who've cut a couple of laps, Ben, but if someone comes now and they might have come in the last 6 weeks, there's a lot of stuff to get through.
A lot.
So I don't know if you know this, Ben, but it seems like AI might be becoming popular. I don't know if you've read anything or heard anything, but apparently AI is becoming popular, and so we've decided to jump on that bandwagon. So I'm just doing a little advance notice that next week we're going to launch something very exciting,
Very exciting.
which we think is the Australia's first property AI opportunity, Ben. And
Ooh.
basically, what that'll mean is people will be able to interact with our AI, the TPC podcast companion, where they can go and they can ask it a question, Ben, and it's got all of the back catalogue of everything you and I've said for the last 10 plus years on the Property Couch community. Includes questions you can ask on our books, questions you can ask on our episodes, questions you ask on our free reports. So it is the biggest life hack we've got, bar none.
We've been working on it for several months in the background, Bryce, haven't we, with our tech team so it is an exciting time to be able to access that rich information, hopefully with not too many hallucinations. So we'll have a little caveat there, but obviously this is where AI is going to make life a lot more efficient and a lot more productive for a lot of users. So if you want to then, when did Bryce and Ben talk about auctions and auction strategies? It'll tell you the episode, and so you can get quicker to outcome or quicker to insight. And so we think we're really excited about that sort of. People's time is valuable, with obviously thousands of hours of our podcast. It's hard to get through and cut all of those laps. So this is going to help those people who can get to the rich information that they want to learn about sooner rather than later. So I can't wait for the release of our companion.
And Ben, we're going to party where people like to party, right? So all you'll need to do is go to WhatsApp and just interact with WhatsApp. People are interacting with WhatsApp already. So all we need to do is give you a number, and then you can interact with the Property Couch.
Call the Property Couch. I'm just going to call the Property Couch. I'm just going to ask.
Don't call them, Ben. We'll type at
the
stage.
Type. Sorry, type. I'm going to text the Property Couch.
So stay tuned next week, folks. That is an announcement that we're excited to do. So Money Smart.
One day I'm sure you'll be able to call.
Hey, say that again.
One day I'm sure you'll be able to call, but at the start you're just going to be able to text.
Yeah, well, maybe one day you and I have a pre-chat before we go live, and we can talk about what we're doing. But Money Smart's 2.0, folks, and of course our TPC companion will be launched next week. So hey, we have a really exciting episode today, Ben. We are in the walls of the Australian Taxation Office today. We are speaking to Rob Thomson, who is the Assistant Commissioner for Taxation there, right?
One of the Assistant Commissioners, yeah.
Now, folks, before you sort of glaze over, I want you to make sure that you stick around, because we have got some insights that are incredibly important.
They are.
For anyone who is a property investor, wants to be a property investor, who is interested in selling a property, even if you're not a property investor, Ben. So
if you want to get all your money, Bryce, and when you sell the property. If you're not interested in getting all of your money, then don't hang around for the show. But if you want to get 100% of the sale proceeds before you have to pay the commission to your real estate agent, well, I think it's worth hanging around.
It's definitely worth hanging around. So some wonderful insights. It's a rare opportunity to speak to someone who is on the inside at the Australian Taxation Office. So make sure you stick around for that, folks. But before we get there, my Mindset Minute theme today is from Joe Rogan, the great podcaster, Ben, who's done many things, stand-up comedian, involved with UFC. He's got a great podcast. So the rules are there not to restrain you, but to reveal new paths for growth and opportunity. And I thought, isn't that topical, given the fact that we are going to talk about someone today who's going to help us better understand the rules in this country when it comes to property investing. So often we approach rules, especially financial ones, with a mindset of resistance or frustration. But if we change our perspective, these tax laws and regulations and financial structures, they're not there to restrict us. They're a roadmap to an opportunity for those who take the time to understand them. Underline that, for those that take the time to understand them.
It's
so rather than seeing these
rules of the game.
Yeah, well, rather than seeing as a series of no's and musts, we can look at them as a framework for creativity and growth. So by embracing financial literacy and understanding the system, you'll get a powerful edge, allowing you to leverage what exists in your favor. So the mindset shift from restriction to exploration is a chance to see what's possible when we fully understand and use the tools around us, Ben. So I thought I'd set that up
I
for the
like that. I
conversation
like that a lot.
that you and I recently had with the Assistant Commissioner of Taxation, Rob Thomson. Let's cut to the interview we recently had. All right, Ben, we've got a very special guest today. We are chatting with Rob Thomson. He is the Assistant Commissioner for Experience, Government and Case Leadership for Individuals and Intermediaries and the official tax time spokesperson at the ATO. An experienced tax professional with over 10 years experience, Rob has recently returned from his role as Minister Counsel in brackets taxation at Australia's permanent delegation to the Organisation for Economic Cooperation and Development, also known as OECD, Ben, in Paris. He has extensive experience across several diverse roles in the ATO. Starting at the ATO as a postgrad in high wealth individuals, Rob progressed to a compliance officer role, then worked his way into specialist task forces, policy implementation, and strategic programs. Rob also holds a Masters of International Taxation and a Bachelor of Commerce. And prior to joining the ATO, Rob worked in a managerial role for a not-for-profit foundation in New York. First of all, welcome to the Property Couch, Rob.
Thanks, Ben and Bryce. Thanks for having me.
Mate, that is a very, very diverse CV, which we're going to dive into very, very shortly with you. But first of all, thanks for joining us on the Property Couch. It's not often we get to speak to someone who is essentially the authority that all of our audience needs to honour and respect, given that at the end of the day, with property investment, they need to lodge a tax return, right? So we're getting some inside information from you today. But before we go there, we'd love to get to know our guest, Rob, and we'd love to get to know you too. And we're keen to find out about money conversations growing up in your household. Did you talk about money over the dinner table?
Bryce, probably not that much, to be honest. Like, not over the dinner table. Like, I think when we're younger, we probably didn't have a lot of money. So we didn't talk about it that much. But, we'd see Mum every week. Every fortnight, she got to pay, put the money in the envelopes. This was back in the 80s, and make sure that she had the money for all the bills, So there was definitely, you saw the budgeting go on. I think as we got older and we started jobs when I was a teenager, obviously Dad had talked to me and Mum had talked to me about what we're going to do with the money, save a bit, not spend it all on stupid stuff as you do when you're a teenager, and try and instill some financial management into a teenage kid, which isn't always the easiest. It's probably not a lot of discussion straight up at the dinner table, but, I think an element around, seeing what my parents did around budgeting when we were younger, but then also, trying to influence your teenage kids as they kind of move into their formative years, which is, a tricky task.
A very tricky task, Rob. So can you give us a little bit of context? Whereabouts in Australia did you grow up? You said there wasn't a lot of money going around. So give us a bit of context around that.
So I grew up in a farming background in the southwest of Western Australia till I was about 5 or 6. Then we moved from the farm to Perth, where my dad started a new career as a trainee ambulance officer. So obviously he was on a trainee salary starting as a junior. So not we survived, but weren't flush with cash, and Mum spent most of the time as an administrative assistant for a union. So we spent all of I kind of grew up in Perth, went through high school, and then did a bit of traveling and moved overseas a bit in my 20s. Range of jobs, including the non-for-profit in the US, before kind of coming back to the ATO and starting my career here, which has been fantastic.
Fantastic. So tell us about when you first started earning your own money. What was your sort of experience around that sort of, it sounds like your dad's given you a bit of advice around saving or putting some money away for a little bit of delayed gratification. But did you sort of have a part-time job, or did you have any sort of allowance or any type of money story there? And when you saw the other kids with the latest BMX bike or skateboard or whatever, were you sort of desperate to sort of be part of the group?
No, look, I don't think we ever felt like we missed out, if I could put it that way, when we were younger. Definitely some of my friends had cooler toys than me. I think later on in life, I've learned to reflect, though, that my parents spent more time with us than gave us toys. So, that's probably actually, the more quality time is better. I started my first job was as a pharmacy assistant, part-time in a pharmacy. So, I think my aspirations then were to buy my drum kit and buy a ticket to Big Day Out. And that was my first lesson in learning that you had to make a choice, and you couldn't get everything you wanted when you earned money. So they were the decisions of a 16-year-old, growing up in the late 90s that you had to make, right? The really tough calls in life, Big Day Out or the drum kit. But no, I think it helps you I think when you have a part-time job, you want to start
100%. It does. And in terms of your first experience with debt, did you take out a sort of personal loan for a car, or did you take out a credit card or anything like that in your younger years?
Yeah, no, so I had a credit card when I travelled.
Yep.
I think, and maybe when I was in London, I racked up a bill on it, as we all did. Had a bit of fun around Europe, and then realised we'd travelled too much, and now we needed to pay it off, and that kind of curtailed the travel for a little while in London. But it's one of those things, right? I think you live and you learn on some of this stuff.
Rite of passage, as they say.
That's right, Ben. That's right.
So, Rob, it seems like there's more sort of osmosis. You were just observing, seeing what Mum and Dad did. You obviously did you adopt the saving mentality that they had, or did you bust out of that when you had your independence and deviate from that saving? And I guess with the farming background, there's seasonal stuff that they needed to navigate as well.
Yeah, right. So I think. I don't think I saved that much in my early 20s, which I don't think is uncommon when you're kind of, young and traveling and kind of have less responsibilities. I think as obviously I've got married and have a kid now, obviously your priorities and kind of financial stability and trying to make sure that you are financially stable kind of changes your priorities, and probably have started to do some of those habits that kind of, about putting little bits away, making sure you're trying to put a little bit away where you can. Every month is kind of something that's now obviously practice when possible.
Yeah.
Brilliant. So, all right. Well, we if people are watching this, they'll see. But for those just listening, there's still a connection to your drumming and traveling past, because you're busting out one of the best beards ever seen on a podcast. But if we pivot to your professional life, I went through your CV, which is impressive, but you weren't always the assistant commissioner at the Australian Taxation Office. So can you kind of get, from that early travel on the credit card, going overseas, going to the Big Day Out, where did you sort of pivot to what is some really interesting and diverse roles that you've attacked in your professional career? What was the progression? What was the spark or catalyst for you, on the runway you are now professionally?
Yeah, it's a really good question, Bryce. It's probably a bit of a pivot, to be honest, as opposed to a smooth transition down one runway. So obviously, I was living in London, and then I did some work in the US and ended up falling into a kind of almost full-time career there, working for a non-for-profit foundation that served children. So we used to serve at-risk and special needs children and have a number of programs aimed at providing charity to them, including running a summer camp for a little bit of the season. So I did that for a number of years while I was kind of thought I should probably finish my degree, after kind of taking what a 6-month hiatus turned into a 6-year hiatus by the time I finished it. So I kind of got to the point of going, okay, I need a profession now, and I had a number of board members that were quite successful and well connected in New York City, and other people I knew. Was thinking about staying in the US, and then kind of GFC happened, and it kind of made me realise that Australia is not a bad place to live, but also then started to think about career options. And I think because I'd spent a lot of time working a role to giving back to the community, it was really important for me that my next role was about had a service element to it, and that's kind of what drew me to the ATO.
Yeah, wow. Okay, so we have asked you to give us some insights into stats, processes, things that are applicable to property investors. So there's a few things that we're going to cover off with you today. We're going to go through some of the latest stats. We're going to talk about self-assessment, what it is and why that's important. We're also going to talk about the role that audits and data matching play in the role that the ATO does. And we're also going to talk to you about what's on the ATO radar. But Ben, maybe you want to kick us off.
Yeah, I love my data, Rob. So, every year I wait with anticipation for the stats to come out through the ATO in relation to rental properties and individuals and self-managed super funds and corporations and who's playing in that space. So let's talk to the latest 2021-22 stats. And what were the headline numbers that came out of that, out of those results, Rob?
Yeah, sure, Ben. So let's talk about the stats for rental properties, maybe.
Yeah, sounds great.
So I've got them up in front of me, so I make sure I get the right figures because there is a number of stats, right? But so we got 2.2 million rental properties were reported to us. 2.3 million people reported on the income tax return having rental income or deductions, and 71% of those owned one property. So that's either individually or jointly. There's $50.4 billion of income that was reported and $44 billion or more than $44.4 billion in deductions that were claimed. And so in 21-22, this showed that about 58% of properties were positively geared. Now that's 21-22. That fluctuates a little bit depending on the interest rate, but that was positively geared to a rate of about $6 billion. Interestingly, 87% of landlords reported or lodged through a tax agent. So, property investment and the tax consequences can be quite tricky. So a lot of people, do seek the help of a tax agent. And also 75% of individuals reported on the income tax schedule a deduction for a rental property manager or rental property expense. So, they're probably the headline figures.
Yeah, interesting stuff, Ben. Hey, there's a couple of things there that I think are interesting, Ben, is 58% of properties are positively geared to the rate of $6 billion. So clearly as interest rates start to grow, that'll fluctuate. But that's an interesting step for you and I to ponder, given that a lot of the narrative is around the majority are getting needed gearing benefits.
I think it's important to understand. I mean, I think there's this perception that everyone just gets into investment property for a big capital gain, and they're happy to sort of run the property loss for a future gain. But obviously, a lot of what we talk about here is, building wealth and building passive income off the back of that is demonstrated in the data here when the cost base is lower. So that is a product of obviously record low interest rates. And so that's yielded obviously a positive income return for government, which they'll charge taxes against. But from the investor's point of view, it's really important to understand that, building that passive income is just as important as that future gain. And that's why we're strong advocates of a couple of really good investment properties supplemented with your superannuation is a really sensible way of building financial security. And that's sort of showing up in that data that with 58% of those holding those properties for the longer term, there'll always be some type of expenses. Coming back to the point around 75% of individuals recorded a claim of a deduction. So if you do run a property manager, or if you've obviously got some expenses associated with that property. So I think that's fair and reasonable in terms of, in fact, I thought probably it could have been a little bit higher if there were some further deductions. That seems like maybe someone didn't have their supporting evidence. So it's really interesting. And it probably is a good question in terms of why, Rob, why do we obtain these sort of numbers, and why are they important in terms of sharing those statistics to the general public?
Ben and Bryce, so I think with respect to all our statistics, it's just about an element around transparency. So obviously we have reporting requirements across the ATO, but we also do want to make sure that there's transparency in the data across all the statistics that we provide to the community. As I said, the most recent ones are 21-22, but that's part of the reason.
And so how do you obtain that sort of data, and why is there a lag in the data, Rob?
Yeah, good question, Ben. So we have to wait for the year to be over. Obviously, can't do it mid-game. I think we've all seen footy games where mid-game it's looking one way, and then by the end it's something completely different. So we definitely have to wait to the end of the year. Obviously, then, as I said, if you talk about rental property data, 87% of the people, property investors use a tax agent. Tax agents have an extended lodgement program that means they essentially can lodge through till the following year.
Yep.
So that causes a lag. And then it's not until we have that and we have all the information statistics, and we obviously go through a QA and publishing process around that data to make sure we've got a level of confidence in it, that it's kind of ready. And so that's what causes the lag. And you can find a lot of information at atu.gov.au/tax stats, which has all the tax stats, the most recent tax stats that we have available.
Yeah, because we get that a bit, don't we, Ben? Where we are quoting, particularly when we do presentations, we do like to use source quotes from the ATO, right? So there's always been a lag when we've done that. So it kind of makes sense that there's no point reporting stats that aren't complete. So therefore, you will only ever get a couple of years ago stats to reflect where we're at. And there's a bunch of extrapolation that you can do from that anyway, with perhaps the exception of expenses, Ben, because that does fluctuate in the current, interest being the obvious one. So, hey, Rob, we can sort of clear up for our audience self-assessment. We hear about that a lot, but what does that actually mean? Because at one extreme, you could just go, oh, self-assessment, I'll decide what I want to put into my tax return. But let's get specific about what self-assessment actually means, and why that's important for everyone to understand.
Yeah, look, Bryce, someone could decide what they want to put in their tax return and make up a figure, but they're probably going to get some questions from us, right? So let's talk about the self-assessment system. And we know most people are wanting to do the right thing. And so basically the self-assessment system means that you're declaring to the ATO when you lodge a tax return or any other form that you're accepting the information you're providing to us is complete and accurate. And so that replaces the responsibility on the taxpayer to ensure that their tax return or the other form that they lodge is correct. The responsibility is not on the tax agent, it's on the taxpayer. Something to remember. And so like more than 96% of all tax compliance is voluntary. So it's kind of for the individuals not in business. So that comes in through the tax return. 96% of taxes we assess as correct. So that kind of means that the majority of people are being accurate and complete in the information they provide to us when they lodge their tax return in line with the self-assessment program. It doesn't mean you can claim whatever you want, though.
Confirm it here.
Look, we have lots of checks and balances as we lodge a tax return, and we get data from a range of sources that we use to compare against the information you've put in your tax return. Some of it we even try and pre-fill into your tax return for you, such as your interest and your salary data, so it's there for you to help you get it right the first time. But we do use that data to see if there's any discrepancies, and if there is, we'll kind of let you know or reach out to you. And they're becoming more sophisticated, Ben and Bryce, over time. Our processes there, and that's really because of we check a lot of stuff against third data, and over a period of time, the data that we're able to collect is better, and we get more data, and that means that we can kind of help people as they're lodging their tax return to try and get them in the right direction. We want to make sure people get it right the first time where possible. As I said, 96% of people. So kind of that's the self-assessment system. Essentially, you're responsible for what you put in your tax return.
Hey, Rob, my kids love this television show called Hunted on Channel 10. You may or may not have seen it. And so therefore, by default, I get to watch Hunted with them. And what's been amazing about that is just the level of cross-checking and data that they get access to actually pinpoint where the people are. It's mind-blowing. And I think it sets a really good context for our next question, but also the ATO, because I think people would really need, in an age where AI is now becoming more prevalent than ever, but prior to AI, there was a whole bunch of things that you guys could do to actually cross-check some of this data. So if someone lodges their tax return, people need to know it's not in isolation, because this is not your first rodeo, is it? There's other things that you get to do with other types of data to cross-check the tax returns. What sort of data do you get access to?
So Bryce, we get a range of data from different sources that we then use to kind of help help people with their tax return for different elements of it, and then kind of identify where something doesn't also look right, and just kind of get, check up on that. But if we talk about rental properties, so we do get a lot of data when it comes to rental properties. So this includes landlord insurance as one, which provides kind of information around insurance payouts that should be reported as rental income. And also landlord insurance premium expenses. We get residential investment property loan data, which provides interest expense and borrowing expenses, but also helps us to identify where someone is essentially renting their property out. We have real property transfer data, which kind of provides us information as to when someone might sell their property, sell their investment property. So that's obviously allows us to identify when someone might have had a capital gain that they need to report on the tax return. We have rental bond information data that provides details around the bonds that have been paid. And so that obviously needs to be reported as income, but also once again, an indication that someone is renting their property out. And we have data from the sharing economy platforms, which are your short-term accommodation provider platforms, which provides income amounts, but also fees that are obviously deductible as the expense you have to pay to the platform. And we also get property management data, which obviously includes rental income, but water rates, property management fees, and other deductible expenses that the property manager may pay. So we get all of that, and this data. So we get this data as well through software providers, and they kind of have to give us the rental expense data for residential properties that are managed by a property manager. So really, that gives us a really rich picture around when someone, it allows us to identify when someone is renting out their property, but also gives us a lot of information to help people get their return right, or identify perhaps when someone's missed something on their tax return.
And Rob, often around the time of the tax season, we are getting communications from the ATO reminding us of the areas that the ATO will be focusing in on, and often rental properties is part of that focus to try and get the accuracy right. Do you audit that type of information? And when you do that, what sort of insights do you learn from that?
Yeah, man. So we use our audit program, but also our data kind of matching and data analytics program to kind of identify areas where we think taxpayers that have rental properties are getting a little bit confused at times. One area which is pretty interesting, but we're not surprised at all, is the difference that landlords seem to get confused by gross rent and net rent, and kind of incorrectly put it in the return. And that's for both long and short-term rentals. So gross is the full amount, right? So you've got to report the gross rent without any expenses taken out. But what we've seen is, instead of reporting the gross rent, some property investors, use the net rent from their report they've got from the rental property manager, which includes all the expenses that you could have deducted or potentially deducted in generating your rental income. And then they go and include all the other expenses again in their tax return. So they're essentially double dipping, and we kind of say it's a bit like good party etiquette, right? You don't double dip the chip twice, so don't double dip your expenses twice. So it's just about, that's one really good example around where just a lack of understanding around the difference between gross and net rent can actually lead to some compliance issues for the taxpayer.
Ben, we got in trouble as a kid for double dipping, and now we'll get in trouble as an adult for double dipping as well. But it kind of makes sense. But look, I think it's always important for everyone to know that ignorance is no defence either. So if you ignorantly did that, that's not going to get you off the hook, right? But there is it's a fundamental accounting concept that you just talked about, net versus gross, and making sure you don't double dip. But it would seem that you, as comical as that might sound for Ben and I now, and some of our audience, it's not as if you haven't found examples of it, is it?
No, that's right, Bryce, and that's why we're trying to educate people. We know that not all property investors have probably done accounting or done finance. They might be tradies, labourers, teachers. They might have not accounting teachers, but so they might have not have a background, and so some of these concepts might not be as evident as they are to us, and new as they are to others, and that's why we're trying to educate people. We have identified taxpayers who've just failed to report all their rental income, yet they have a property manager looking after the place. Like, that is a concern to us. That one is, you're gonna get a call from us about that one, right? So, there is a bit where we do want to try and educate those people that are trying to do the right thing to help them comply and get the tax return right. But those that kind of choose not to, we will be in contact with them.
Yeah, no, we shouldn't laugh at that. But I mean, it does seem quite ironic that you'd have a property manager and you've received no rental income over the course of the 12 months of operating that property. Oh, there are funny people in this world.
Yeah, let's say, Ben, that one does cause us to ask a question when we see it.
Oh, I suspect it would. I suspect a little flag in the system would go up there, Rob, in terms of what actually happens. With so many people sort of obviously managing properties, and we're a big fan in terms of getting a property manager to actually assist with the management and obviously managing the relationship with the tenant as part of that. In terms of engaging a property manager to rent their property out and basically try and seek a return, what's the advantages of that? And do you think that they help in respect of the types of support they can give in recording the claimable items?
Look, good question, Ben. I think from a tax office perspective, what we say is how people structure their investments and manage their investments is their personal decision, and they should seek advice from others, not us. We're here to tell them what the tax consequences are and tax advice. But record keeping is key. So whether you're using a property manager or you're not, you need to make sure that you've got good records to substantiate your claims and to kind of show how you've calculated the amounts on your tax return.
Hey Rob, tell us a couple of examples where you've caught some people maybe two people who have got an investment property together, but they've gone, let's just report all of the income and expenses on investor A and ignore investor B, or vice versa. Can you talk to us about what that looks like and maybe straightening up on if that's okay?
Yeah, Bryce. So that is another common error that we see, is where a property is owned by more than one person, but only one person reports the income and expenses. And so all owners are required to report the income and expenses consistent with their ownership in the property. Now, you can have tenants, you can have, ownership in common, you can have joint ownership. There are legal differences. So you do need to understand those and then working out what your tax compliance obligations are. And there's information on the ATO website in our investor toolkit that helps you to understand, based on your ownership structure and how you own that property, as to what you need to return in your income in terms of income and expenses.
That might have just ended the party for some people, Ben, where they just go, I'm earning too much income. We'll put that on the other person's one. No, it has to be whatever's on the title or whoever's the legal owners. You've got to declare it in the appropriate proportions. Another thing that, and we've talked about this previously on our podcast, Rob, but it never hurts to have a nice little reminder here. But the difference between a repair and an improvement, and the fine line, the delicate dance that is often made around the definition of those two things.
Yeah, right. So this is another one, and actually this year is one that we is probably, in terms of rental properties, one of our main messages to investors, is to understand the difference between repairs and maintenance. So you spend money on something on your property to repair, replace, or improve something on your property, and we see people mistakenly think, well, I spent money on my property, it's I can claim it this year, the whole amount. Claim it immediately, done and dusted. However, expenditure can actually be an improvement, and so it has to be capital in nature. Or you could have purchased a depreciating asset. So it could be any one of these things, and if it's not the first, being an initial repair, then you do need to claim that expense over a period of time, depending on whether it's capital or a depreciating asset. So a really easy example is few cracked tiles in the bathroom. You replace the tiles, done and dusted, a few tiles, repair those in the bathroom, repair. You decide to renovate the whole bathroom because you don't like the cracked tiles anymore. That's an improvement, and you need to claim that over a period of time. So this is kind of the difference. There's a lot of these, and there's some really good examples in our investor toolkit to help people understand this difference between what's a repair and you can claim straight away, and what's something you need to kind of claim over a period of time.
Rob, is it kind of like getting it back to the way it was is a repair, and making it different to the way it was is more likely to be improvement? I know it's not definitive, but just to give our listeners a bit of a guide, just getting it back to status quo, repair, any changes is an improvement.
Yeah. So if you're essentially, Bryce, if it's to bring it back to its basic functionality, it's a repair. Anything more is going to be an improvement, or if you're replacing a depreciable asset, such as an air conditioning unit, that's not immediately deductible, and you need to be deducting that over a period of time.
And Rob, obviously, the other thing that we also might be confused about as investors is the timing of when we potentially fix, repair, replace, upgrade, and whether those deductions are applicable. So an example might be that when an investor buys a new place for rent, and they've bought something that might be a bit of a reliable and durable, but needs a bit of repair work done or some upgrading done. When those repairs are needed before the tenant moves in, what are the consequences of doing those types of repairs before moving the tenant into the property?
Really good question, Ben. So those kind of repairs are called initial repairs. So initial repairs are different to normal repairs because you're not fixing something that's kind of been damaged or just worn out by the tenants. So repairing damage that existed when you bought the property, whether you do that at the time of buying or later on, down the track, is likely to be an initial repair. And in most circumstances, that expense is considered to be a capital works deduction. And so generally you can claim 2.5% of the expense over 40 years. Unless it's second-hand assets, then there's some other rules. This is why it's worth having a look on the website or engaging a registered taxation if you're not sure. But the other thing to remember is capital works and capital allowances can also be factored into your capital gains tax calculations when you sell. So once again, really important you have good records, and then that way you can make sure you're claiming what you can every year. But then if you go to dispose of the property, you've got all the records you need to make sure you're calculating your capital gain correctly.
Ben, that might have been a little sleepy one for some folks too, because you go, okay, the difference between a repair and maintenance, got it, or an improvement, got it. But then you go and sneak that one in, and it says, well, if you didn't have a tenant in place and it was in place before you bought it, that actually has a new set of rules. So I think that one's
kitchen cupboard doors broken or hinges aren't working properly, and you're thinking you're doing the right thing so you can attract a good tenant. But ultimately, you might have an initial repair as opposed to an ongoing repair.
Well, our audience is pretty familiar with depreciation, but not all of our audience, Rob. So we probably should go over, if you could just give us what qualifies for a 2.5% capital works allowance, and what would be a depreciating asset that's over a shorter effective life. Can you sort of highlight the difference between the two?
Yeah, so anything that's really a structural to the structure of the building is capital in nature. So, improvements, remodeling the kitchen, remodeling the bathroom, as I talked about before, carport, all those kind of things, 40% over 2.5. So 40 years at 2.5%.
But what about an air conditioner? Let's go, okay, we just put an air conditioner on the wall. We're not going to do that over 40 years.
So that's where they're also capital in nature, but they're called depreciating. They're called capital allowances, and so depreciating assets essentially have an effective life. And so there's a lifespan that, say, the air conditioner is expected to last, and you can claim it over the period of the effective life of that depreciating asset. Now, once again, the deduction may be limited to whether it's a new one or a first-hand, depending on when you built when you purchase the building. But we have some pretty comprehensive lists on the ATO website around all the different depreciating assets. In our rentals guide that outlines kind of how long things are expected to last and how you can claim them. And I think we'll probably add some of the list to the podcast to help everyone. But a couple of things to remember. Normally, you can only claim new depreciating assets. If you buy an existing property to rent, the assets are considered second-hand, along with any other assets that you might install that have been used elsewhere. So once again, a bit like initial repairs, it will depend on the time at which you purchase the depreciating asset. So for example, a new dishwasher in your home, and if you buy a new dishwasher and you put it in your home and you put the used one in your rental, you can't claim a deduction for your old dishwasher that you've bunged in the rental. Of course, if you buy a new property, the installed depreciating assets are also considered to be new.
So Ben, let's land that plane. So we've got a rental property. We just go and buy an air conditioner.
Yep.
Let's say the air conditioner costs us $5,000. And what the ATO might say, and they've got an approved list that you can go and see all their details, but it'll say $5,000. We think it's going to last 5 years. And you might be able to depreciate that over, let's say 5, but it'll be 6 when we get to it. But 5 years, $1,000 each, because they're saying it's not all being used in the first year. So therefore, we've got to sort of drag it across different tax years, right? Now, in effect, in the first year, you probably get a pro rata, and in the last year, you get a pro rata. So it'll go across 6 years. But that's first of all, we can break up the cost and depreciate it over a number of tax years, and it becomes a non-cash deduction, which is a nice little bonus in tax return land, where you actually get a deduction for something that you didn't have cash flow out that year. So that's one. Number two, let's say my investment property needs an air conditioner, Ben. But in my house, I've just upgraded my air conditioner. So what I've done is I've taken the air conditioner off my wall and I've walked it over to my rental property and put that air conditioner up on the wall. What the ATO is saying, no, that doesn't count. You cannot claim depreciation on that for your investment property because that's no longer new. And I think, Ben, you'll know this better than me, but I think it was May 2017. Was that the notice when our good friend Bradley Beer...
Was it the 15th of May or the 17th of May, I think, of that
2017, year? Where those rules actually changed. So if you're
Rob, do you remember which year it was when the
testing the memory right now, Ben?
Yeah.
But
that's all right.
But no, this is good. Why I think this is the point. The rules can be quite complex, right? There can be different outcomes, and it can be dependent on the timing. So this is really important. Why have a look at the ATO website.
It was something like 7 p.m. of that night.
Yes.
When the Treasurer did the reading, the public reading in Parliament of the second reading.
Yeah, that's right.
If you had found out about the first reading at 2:00 in the afternoon, what would you have done? I quickly need to buy this property.
Exactly. And our good friend Brad Beer, who has a depreciation business in this country,
yes.
I remember he said he choked on his steak when he saw that. So anyway, Rob's not going to comment on that. So I guess there are some changes.
Yeah, change of pace here. Yeah,
that we should expect in January. In fact, the 1st of January, Rob, that will affect not just some people, but every Australian selling property. Can you tell us what that is?
Yeah, I can bet, Bryce. And probably, that's right, there are some changes, but probably one caveat. The legislation will actually make changes to the existing regime, which already impacts a number of Australian residents when selling. The changes are before Parliament, which means that if they are passed, they'll impact all Australians. So it's one to watch as it goes through Parliament. But these changes are to do with the foreign resident capital gain withholding regime, or FRCGW, as we call it in the ATO, because saying foreign resident capital gain withholding regime starts to get a bit repetitive, which is a bit of a mouthful, but it's a really important topic for Australian residents who are selling a property. So at the moment, under the current law, if you're an Australian resident for tax purposes, you must have a clearance certificate where you're selling your property and it's valued at $750,000 or more. And so a clearance document is a document that the ATO issues to prove that you're an Australian resident for tax purposes, and you obtain that document from us and you give it to the solicitor or the conveyancer as part of settlement process. But without that certificate, you're treated as a foreign resident. And at the moment, it's 12.5% must be withheld from the property sale price, and it's paid to the ATO. So at the bottom of the range of that, at the current rules, $750,000, it means that you'd have $93,750 withheld and sent to the ATO, which can obviously severely impact your property transaction. But if you're using those funds to kind of, buy your next house or something, that can obviously impact your future financing. So the proposed changes to the regime that are before Parliament at the moment would remove the $750,000 threshold. So if passed, that means that anyone selling a property in Australia that is an Australian resident will need to get one of these clearance certificates. And the proposed changes also increase the withholding tax rate from 12.5% to 15%. As I said, still before Parliament, so we can't preempt any decisions, but it's important that if you're selling, that you check with your solicitor or your registered tax agent if these rules apply to you. If you are looking to sell in January, there's no harm in getting a certificate from us, even if you think you're going to be under the 750,000 limit. But please do be aware of these changes.
So one assumes, Rob, that as part of obviously the selling process, you prepare your contract of sale and all the relevant information as part of that. You normally would engage a solicitor or conveyancer to act on your behalf as part of that transaction. So I suspect it's just going to be an additional part of, where I have to also present a title search, et cetera, and so that's just going to, sort of blend in with the sale document.
So where we find that people are kind of do use the conveyancers as part of this process. It depends on who they've engaged and how they're selling, depending on the state. But what we'd say is clearance certificates are free, right? And they last 12 months. So and if you don't use them, there's no penalty or cost. It's free to get one. So don't wait until you sign the contract, before applying for one. You can, apply early and get one early, even if you're thinking about selling. It's one less thing you got to worry about when you're trying to sell everything, pack the house, and it can take up to 28 days to process. So make sure you do apply. People try and, apply and go, oh, settlement's tomorrow. So, what we're saying is, make sure if you think about selling, get one early, one less thing you got to worry about later on. Also, if the property's owned jointly, everyone on the title deed needs to get their own clearance certificate, and these might have different process times. So if yours arrives and your partner's doesn't, just be patient. It can be 28 days. But this is why we're saying get it early, and then you don't have to worry about it.
Important. That'd suck. We'll go to settlement. One person's got it and the other person doesn't. That's holding them up. That'd be not ideal. But so if everyone follows the rules, Rob, it probably just means it only affects foreign residents, right? Because if everyone gets their sales certificate, you won't withhold anything. It's obviously gone up a little higher, but it'll only affect foreign residents and those who don't get clearance certificates.
That's right, Bryce. So the current regime, even in its current form, only affects foreign residents. But if you're an Australian resident and you don't get a clearance certificate in time, you might actually need to wait until you lodge your next tax return to get that money refunded. So if you're thinking, you're selling in October, you might have to wait to the following July. So this is why it's really important that people do apply early if they're thinking about selling their house. Then they don't need to worry about this issue.
And sort of how do they go about doing that, Rob? It sounds like apply. Is it a form we download or is it a process we go through? Tell us a little bit about that sort of application process and where to find it.
Yeah, Ben. So you can apply through your solicitor or your conveyancer or your registered tax agent if you've engaged one of those to help you with the sale of the property. But you can also go to our website ato.gov.au/clearance certificate, and that's the form that you need to fill in.
Okay, so it's pretty important just to let everyone know this is an awareness thing. So that's why we wanted to talk about it. It's still, to Rob's point, going through Parliament. So there is, we've got to wait for the final legislation to land. Hopefully that'll be done over the course of the next couple of months, but it'll be something that you would like to think that, Rob coming on here is educating our community and And I'm sure there's lots of work being done in terms of educating the real estate community as part of that particular process. So hopefully it's not too long before everyone is aware of this particular process and goes through that. The 28 days is obviously something to consider as well, because I didn't think it would take that long. But you've been warned. Hopefully data processes and efficiencies speed up over time, but that just gives you some idea in terms of what's there. Yes, Rob.
Look, and what we're just saying that is actually just an important caveat for everyone. Why there is legislation going through Parliament, this is actually currently an existing regime. So,
Yes.
just be mindful, if you're selling, say, you're selling a house, it's $1 million, you need to get one now. It will just be that it will impact those that are selling a property under $750,000 under the changes before Parliament.
Good tip. Really good tip.
And definitely helps with data matching too, Ben, if they've got all these certificates as well. So something else to keep in mind. Hey, if we move on to another topic, you've got a calculator to help with borrowing expenses. We just talked about depreciation, which is depreciating a tangible asset, but sometimes you have this word amortization, Rob, which is for some people not as obvious as depreciation, but borrowing expenses falls into that category. Can you talk to us a bit about that and how you guys have got some tools to help?
Yeah, that's right, Bryce. So when your borrowing expenses are more than $100 in total, which is almost everyone these days, right? Then you need to calculate and spread your expenses over a 5-year period, or the term of the loan, whichever's shorter. And so odds are that you won't be buying your property as well on 1 July at the start of the income year. So you also need to pro-rata that between the first year and the last year, depending on how many days in the year. So we have a new borrowing expenses calculator, which will help you to get that expense right. And just as you kind of put your records together, put all the figures in, then that'll help you to get it right. And you can find there's a borrowing expenses fact toolkit you'll find in a fact sheet around this in our investment toolkit, because we'd also see some misunderstanding around what's considered a borrowing expense. And so it's important to understand what you can claim as part of the borrowing expense, and then how you claim that over a period of time.
Great. And some examples. I mean, what we aren't talking about here is the interest expense. We're actually talking about the expense that may be charged as part of the borrowing setup or exchange. So things like lender's mortgage insurance. We're talking potentially about the fee that the bank may charge you, such as an annual fee associated with setting up that particular loan with that particular institution. So that's why this borrowing calculator will be really helpful for people to get a sense of what is claimable and what might not be claimable.
And Ben, stick around for my life hack, because I'll have a bunch of resources that people can get access to follow up on all these awesome points that Rob's speaking to. But sorry, Rob, I'll cut you off then.
No, I was going to say a good example is stamp duty on the loan is a borrowing expense. Stamp duty on the property is not a borrowing expense, right? So, so some of these things are important, and you can work through the calculator, and the fact sheet helps you make sure that you're claiming the right things.
Yeah, I think the ATO wants to make sure people get that right, because amortising the stamp duty on the purchase would be good for the investor, but the ATO would not be happy about underreporting there. Hey, if we pivot to, Ben just talked about interest expenses. It's definitely one of the, if not the biggest, the definitely the biggest expense for property investors. But surely everyone would claim this perfectly, Rob. No one would overclaim on this one. Come on, surely not.
So, look, Bryce, overclaiming interest is an issue we see, and people do get wrong. So interest paid is immediately deductible, but only the interest on the investment property. So this means that if you've taken the loan out for more than one purpose, like buying a new car or if you've got an investment property, spending some money on renovating your own house that you live in, you can't claim the part of the interest that relates to the private use or the other element. So we do see some confusion there. Also, the thing to remember is you've got to do that over the whole period of the loan. So if you've used 20 grand to go on a holiday to Europe as part of the finance facility, you can't pay the first 20 grand back and be like, all right, everything now on is the investment property. You need to apportion that over the period of the finance facility as well. So it is an area where we do see some confusion. And look, incorrect in reporting of interest expense accounts for about 42% of the tax gap for rental properties. And the tax gap for rental properties, the total is $1.2 billion. So it is a fair amount of cash where we're seeing people get it wrong. And we do have a lot of data, as we talked about earlier, from banks and other lenders that does give us an insight into kind of actually how much interest people are paying.
It's a really good point, and I know, Rob, you won't be able to comment to this, but we see quite often people using refinancing facilities that, they might be in advance in terms of redraw, and to that point, they then go and borrow that money back out, and then they don't adjust for that interest calculation. So that, you make a note here of a $420 million problem in interest or overclaiming of interest, which is that sort of 42% you're referring to. So it really is very, very important. And on that point, we talk about line of credit facilities, and Rob made mention of that in terms of going on the European trip and then sort of paying that off as part of a facility you've got. We cannot stress enough for our community to separate out activities. So if it is for investment purposes and it is for the property, make sure you've got your lending structure appropriately set up so you don't have mixed purpose of uses, because that's where most of the problems generate from. So a good structure, and remember, lenders can give you great ways and multiple splits in loans, and it's getting easier and easier through a lot of lenders to set up those different splits for different purposes. And that just makes the administration work of looking after what is deductible and what is the purpose of those funds a lot easier for you to manage, but also in the event that the ATO does do a check on you, that's really clear for them to see basically the delineation of those different expenses and how you're claiming those. So I can't stress enough about getting the administration right, getting your lending structure set up correctly, because of that tax gap. So, and I suppose that's probably a next logical question for you, Rob, in terms of, can you help define a little bit more about what that tax gap is and why it's so important for you to be collecting that money on behalf of the Australian government?
Yeah, Ben. So tax gap probably sounds like quite a taxi ATO specific term, right? But essentially what it means is it's the difference between what we calculate to be the amount of tax that everyone should pay and what they actually do pay. So with respect to rental property investors, as I said, our current calculations based on financial data from a few years ago is that the difference between the amount that is paid and should be paid is about $1.2 billion.
So, and there's a few things that people can, some obvious ones that they can do to avoid being in that gap. You've talked about a couple of things, but is there any others that you reckon would be worthy of highlighting here?
So, Bryce, I think the one we've just touched on, if you are using a mixed purpose loan or you're refinancing, you're redrawing, make sure you understand the tax consequences of you doing that. The other one is to remember, as I talked about, the loans for 25 years, you've got to apportion that over the 25-year period. And, calculations for this can get complex. And so, it is really important that you understand the tax consequences and understand the record keeping behind them. That's probably one of the main things we'd say. And our investor toolkit, has a lot of information on interest expenses and how to apportion this and how to avoid not claiming it correctly. As I said, we're going to make sure everyone gets it right the first time. And so make sure you keep good records and you've got your calculations set up from the start, and you understand the tax consequences if you're redrawing or refinancing.
And folks, that kind of bridges the gap between why Ben and I always say get an investment savvy mortgage broker, because you don't want to pollute loans. And an investment savvy mortgage broker knows how to make sure that you don't pollute loans. And the end result of pollution of your loans is exactly what Rob's just talking to that point. Your loans get messy. Your $20,000 trip to Europe then has to go over 25 years. It's not money in, money out. There's a whole bunch of rules that just makes that loan very unworkable for a long period of time and hard to get out, because it's all about the intent of the loan, not necessarily the security of the loan. So, hey, Rob, if we pivot, as we sort of head to for home, if we pivot to pay-as-you-go instalments, probably not a lot of investors think about that property investors, particularly during the accumulation phase, which is largely because they have a situation where their expenses exceed their income, hence the term negative gearing. But at some point, they move to an equilibrium. And then beyond equilibrium, to your earlier point, around 58% have positive income reported. They will then need to start thinking about that income being taxable. And for a lot of people, if they've only been used to being a pay-as-you-go earner, where their company that they work for just handles the tax for them, it's new territory. So can you sort of talk about pay-as-you-go installments and maybe open up that possibility to some people who may not have thought about that before?
So pay-as-you-go installments is essentially a system that allows you to prepay smaller amounts during the year, so to kind of equate to what's the expected tax bill at the end of the year, so you don't get this massive tax bill at the end of the year. So it's about paying it during the year. So there's two ways that you can enter into the PAYGI system. The first one is automatic entry, and generally this means that if you're got business or investment income that's more than $4,000 for the year, then we will automatically enter you into the PAYG system, and it'll help to calculate how much you owe through the year. So when you get to tax time, you've already paid some amount. You can also voluntary enter into the program. So even if you're not automatically enrolled, you can choose to join the PAYG installments process yourself. And this can be a smart move if you expect to be paying some tax at the end of the year. And you want to make sure that you're kind of accounting for that out of your cash flow as you go, and then just not right at the end of the year. Once you've entered into the PAYG installments program, we will send you a letter to your MyGov that kind of explains everything that you need to know about this.
And it's this week as this podcast goes live. It was the 28th of October. As someone who's in that regime, I can tell you. So if you haven't jumped onto MyGov and gone into the tax portal, it's always good to go in there and see what bills you owe to the tax office and get them all tidied up in time. So if you haven't already done that, here's a little reminder before the ATO starts reminding you as well of your unpaid PAYG instalment. Let's move. Sorry, I should ask then, Rob, what are the benefits of obviously a PAYG instalment program?
Yeah, so Ben, put simply, it's just about that element about paying a little bit of tax, smaller payments during the year, so you don't get to the end of the year and have a massive bill or a bigger bill. And it just helps you to manage your finances during the year a little bit more and kind of take that stress away at tax time around how you're going to pay a large tax bill. It's really a little bit like PAYG withholding for your salary, right? Like your employer takes a little bit out every pay, so that then, you don't owe, you're not in a position where you've got to pay all the tax at the end of the financial year and go, how am I going to pay this money? Especially if you're 20-year-old Rob from a few years ago where you've probably spent all the money on big day out tickets and drum kits, then like, what are you going to do, right? So, this is about just making it easier to help people to comply with their tax obligations and not be stressed, have as much stress on them at tax time.
Yeah, and I think it's really important. I know even small businesses with their, they have their BAS payments as well. And if they're not managing cash flow well, it can, as you say, creep up on them and be a bit of a cash flow burden on them. And, obviously we are passionate about our community, making sure that they're organising their finances and projecting future cash flow needs, such as also the tax payable. And so offsets are so important as part of that and keeping that money there, but also knowing when, those installments are going to be made. So those buffer accounts and keeping cash there, we love that idea. And then paying our fees as they fall due, including our taxes, is also a sensible thing to do. So a great little tip there.
Takes us back to Rob's mum's envelopes, Ben, in the early days. She put a little bit in the envelope. So effectively, it's just the modern day version of
exactly.
the envelope system for your tax obligation.
Now let's finish up and we've covered a fair bit of ground today. What are the sort of final last tips, Rob, that you might have for us? Some of the messages that we need to take away from the ATO's perspective.
Yeah, Ben, so probably two. One, we talked about clearance certificates. Selling a house, make sure you get one, get it early if you're an Australian resident. Creates a little less stress on the whole sale process, and it can take a little while to get it. So make sure you get it early. Don't leave it to the last minute, and be aware of those changes that might go through Parliament obviously we can't predict, but we'll
Yeah.
see what happens. Keep an eye on those. Also, records. I think I've talked a little bit about records, but I can't stress the importance of making sure you've got good records and you've got your records set up from the start of any investment property. So, this allows you to understand what you can claim during the financial year, but also can set you up for success in checking what you can claim in future years, and make sure that you've got a good process to store all your records, whether that's an electronic version, whether that's a paper version or a clear photo of the original record. You can also use electronic devices or apps to keep your records. That's up to you as well.
I know a good app.
Yeah, the ATO app's pretty good as well, Ben. So there's an ATO app as well. So I got to give a plug for that. But also for property investors, there's expenses. As I said, you can't claim immediately; you can claim over time. So records are important, and they're not only important in terms of making sure you're entitled to claim what you can claim every year. They're also important when you go to dispose of the property, and make sure that you can include all the expenses in your cost base that you should be entitled to. So really important records from the start. Can't stress that enough.
Yeah,
Great tips.
Hey, we've covered some ground. It's not very often that we get on the inside walls at the ATO, Rob. So you've been very generous with your time, and I think there's been some really incredible messages for our audience who are avid property investors to take heed to and sort of get some nuances around some of the details. But if they want to go and get some more help, what sort of resources have you guys got?
Yeah, so Bryce, I think I talked a little bit about our investor toolkit. Really good place to start. ato.gov.au/investor toolkit has a lot of fact sheets, has a lot of videos, has a lot of practical information on a number of the things we talked about today for rental properties, but also has fact sheets on other things, other types of investments like shares and crypto as well. So a good place for you to understand your tax consequences. Also, there's some videos on there as well. If you're from the YouTube generation and like to consume via video content a bit more than reading, some really good videos there as well to help you understand a lot of these tax compliance questions when it comes to rental properties.
Very
And
good.
we'll put all of those in the show description, in the show notes as well, so easy access to that information as well.
Hey Rob, thanks very much for your time today. I mean, we've learned a fair bit about your music preferences, the drum kits, the big day out, your farming background, but clearly our audience has had a front row seat of someone who is trying to help as many people as possible. Say, hey, look, we're not the big bad bully here. We just want to give you an opportunity to self-assess in a way that gives you the best chance of reporting what should be. And if you do that correctly, you don't get a tap on the shoulder from us, which is really good. So for our audience, I think it's been really insightful. And just for some, it's been a reminder. For others, it's been really insightful and eye-opening. So, mate, on behalf of everyone here on the Property Couch, thanks for joining us today.
Thanks, Bryce. Thanks, Ben. Thanks for having me.
Thanks, Rob. It's been great.
There you go, Ben. There we go. We just got in the walls of the ATO. We got to look under the bonnet on some of the stuff they're doing. But what's really interesting about that is there's nowhere to hide, Ben. They've got plenty of data matching that will make sure that if you are just a little bit loose on the truth, they'll tap you on the shoulder.
I've just got a little note to myself here that says, do the right thing, and everything will be in place. I mean, organise, get all record keeping. We know Julia Hartman, the great Julia Hartman, as part of our tax business, always reminds people that obviously record keeping and bookkeeping is an important part of this journey. So I think that's really helpful. And obviously I can't go without sort of giving a plug to Moorr. We are building more for property investors, and we're building out some of those record keeping features, and also we've got depreciation built into it now. We're going to do some of those capital allocation costs. So there's a lot happening that we're going to be releasing either later this year or early into the new year that's just going to help you manage your property investments so much easier, in addition to obviously transactional records as well, which is coming early in the new year. So I can't wait, Bryce, for obviously having all of that stuff, everything, document collection, everything happening in one environment. So I want to digitize all of my property managements, move away from those spreadsheets and getting it all into Moorr. So there's plenty happening in that space as well.
So, folks, if you're not on Moorr, just go to Moorr, moorr.com.au. Go and check it out. Go and download it. As Ben said, there's all of the things we just talked about with Rob can be captured in there. But Ben, it's interesting. If with all the conversation around negative gearing, I think if we could send out a message to all those who do benefit from negative gearing, if you actually just report correctly. I mean,
Yeah.
there's what was the numbers? 420 million over claiming on interest alone, and I think
Yes.
Rob quoted over a billion
1.2 billion or something. Yeah.
is the tax gap. Imagine if we could just encourage all property investors just to do the right thing. Then there would be a whole lot more money that's being collected that they could then use that for other political advantages other than trying to go after us. So interesting. I thought was how you just describe some of the things that we got to learn. Some of that for a few people were refreshers, particularly around repairs and maintenance and depreciation. But perhaps the initial repair might have been something new for folks to understand. But clearly, use a property manager was the takeaway. Make sure you get a depreciation specialist who can help you claim all you can, and make sure you use an investment savvy mortgage broker, Ben, so that you don't pollute your loans and you can get it tied up in a nice little bow, all of the loan costs that you've got, so that you can correctly amortize that over the journey as well. So just some really
Well
good stuff.
summarised, mate. Well summarised.
All right, thank you again, Rob. We appreciate your time today. My life hack today, Ben, is understandably, why wouldn't you use the resources that are available? So my life hack today is just a reminder of some of the things that Rob talked about.
Check them out.
ato.gov.au/investors toolkit. Go and check that out. Rental properties guide, ato.gov.au/rentals guide. Now, Ben, when I first started, I've told my story a couple of times where I was in these workshops, I was standing up. I had the ATO book printed out. This was back in 1998, the rentals guide, and that was my little Bible. I would read it and study it, make sure I understand it. So if you're a serious student of property investing and you don't have the ATO rental properties guide, you can't even call yourself serious, Ben, because that is the ultimate truth. They're the people who judge whether your tax assessment is legitimate or not. So
it's good to know the rules early, and if you don't make any mistakes, you're not going to get into trouble.
The rental video series they've got, which is ato.gov.au/rental videos.
Yes.
Tax statistics, Ben, /tax stats. And that mouthful that Rob talked about, the foreign resident capital gains withholding, as I take a breath, can go to ato.gov.au/FRCGW. And no, I'm not swearing at you, Ben. And ato.gov.au/clearance certificate. There you go, all in one place, all the things that you need to know. And of course, if you're watching this, Artie will have all of the links up on the screen. And if you're listening to it, just click on the show notes and we'll have it for you there as well. So thank you again for those wonderful resources, ATO. Check those out, folks. Ben, what's making property news?
Well, Bryce, what's making property news? The biggest news that sort of occurred over the last sort of 7 to 10 days was what happened in New South Wales with the Minns Labor government introducing reforms to the Tenancy Act. And so, if on their side of the fence, they're saying that these reforms will mean that 2.2 million property renters across the state will soon enjoy the following benefits, which in their mind is no ground evictions will be banned. Rental increases will be limited to only one per year. It will be easy to have pets in rentals, fee-free way to pay rent, and then the ban on paying a background check when applying for a property. Now, they go on to say that the banning of no grounds evictions will ensure housing security for renters, allowing them to make a house a home. The reforms will also give landlords more clarity on when they can end a fixed term or periodic lease based on clear, straightforward reasons.
Do we need a minute of silence, Ben? Do we need a minute of silence?
That's their spin, Bryce.
Do we need a minute of silence?
Say again?
Do we need a minute's silence just to mourn that?
Well, I mean, does it actually protect the renter? Does it actually give them security of what the intended purpose with this? And that's effectively, so, this is how the landlord sees these types of policies. Firstly, there was no consideration. So if I'm wearing my picker hat, there was no consideration for any of our adjustments to the legislation. So it was just rammed through with all of the support of the tenancy associations and the like, and no considerations for the landlord. And I make a point to the rental commissioner, who obviously was happy enough to at least take my call and have some dialogue, whereas in Victoria, they're completely ignoring us and have tin ears. But here is the point that I made to her, and I'll continue to keep making. The decisions that they've made and the legislation, which they say had some support from industry. But Bryce, if you're a property manager in New South Wales and your business is based on having property investors, small private rental accommodation businesses working with you, are you going to slag off or sort of argue against this reform? Well,
No, you won't
no,
be.
you're not, because you don't want all of those property investors selling up and moving out. That's your business. So, when they're pushed for feedback to the rental commissioner, she's saying they're relatively supportive of it. And I'm saying, well, yeah, because they don't want all their business to go. But if I ask a simple question, which I did of the rental commissioner, which I still don't have an answer for, and I said, given these reforms, they fail to accommodate that these small private rental accommodation providers cannot now remove difficult tenants or difficult clients. There is no provision in that legislation that will allow us to have a working relationship when a working relationship is no longer possible, when effectively the relationship breakdown between either the tenant or the property manager or the tenant and the landlord exists. There's no way of getting out of that other than these very restrictive rules of you moving into the property or an immediate family member moving into property, significantly renovating the property, and there's just no wriggle room. And they've put all of these extra conditions on it, and they even want to fine us for basically evicting a tenant. So it makes no sense to me. And the net result around security for tenants will be there'll be less investment. And so from today, we are saying to all of our picker members, we're not supportive of investing in New South Wales and investing in private rental accommodation in that state with these current legislations. Now, of course, that's still a personal choice if people see an opportunity in that market. But more broadly, this is a restrictive measure that will start to, and this is what I've told them, tens of billions of dollars of private investment will look for another home. It won't be looking in New South Wales under these reforms. They are still too restrictive, and ultimately it will result in less supply, and that will not give this sort of tenancy security that they were intended for, and they're going to have higher rents. So it really is a disappointing outcome where we have literally zero ability to remove a difficult tenant from a property other than selling it or renovating it, or moving in. And that just is unsatisfactory for effectively the 680,000 private rental accommodation providers in the New South Wales market. And as more and more people learn about this, we'll see what happened in Victoria, where we'll start to see more of an exit and a continued rental crisis in New South Wales.
Yeah, and it kind of is a message to the other states that it all started here in Victoria, and it's now slowly sort of emanating through other states as well, Ben, which is not ideal. So hopefully that doesn't have a trend that continues. But
there's simply no benefit, Bryce. There is simply, I've asked the rental commissioner one simple question, another simple question, I should say, and that was explain to me of these reforms in terms of for existing private rental accommodation providers, what are the benefits that we get out of these reforms? There is simply zero benefit. In fact, it's all 100%. The legislation has gone too far towards protecting the client, which is the tenant. And we could have found some middle ground, but unfortunately we weren't able to because of all of the lobbying, which is government-funded money coming from those tenancy associations in terms of this conversation. So yeah, I'm annoyed, I'm angry, I'm frustrated about the decision that make, but it'll ultimately result in worse outcomes for tenants in New South Wales.
There you go. Very good. Thank you for that. And mate, we've covered a lot of ground today from big day out tickets all the way through to no grounds evictions here. But again, I just want to shout out to our very special guest today, Rob Thomson from the ATO, who was very generous in giving up his time.
Terrific.
And sharing his insights and his wisdom with us, and hopefully for the benefit of our community. And folks, if you got some benefit from that, or you think there's some really good fundamentals that you saw there, or that you listened there that you think other people would benefit from, we would love for you to share this episode with your friends and family and all of your networks so that we can get the message out there, mate. But until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Act on it. See you next week, folks.